Hello everyone, welcome to Betty Academy, where we make school easier. Please support this channel by subscribing, watch our videos, like, share, comment down below, and don't forget to hit on the notification bell. So in this lesson, we are going to learn about the factors affecting capital structure decisions. So capital structure in general, that's what we are going to learn. Yeah, these are the points that we are going to learn about: the cost of equity capital, those are factors, change in control, regulatory framework, debt covenants, other factors. So I'll be expounding on those points. So let's start by going through what is capital structure in general. So capital structure, every company needs capital to support its operations. Capital structure is a blend of a company's sources of finance and consists of several types of funding. To be more specific, capital structure is a ratio of short-term, long-term liabilities and equity. So depending on the sources of financing, we can distinguish borrowed, or rather debt, capital and equity. Equity in this case, they are its owner's capital. Combined, they form the company's employed capital. Borrowed capital has two significant advantages. First, interest paid is exempt when calculating profit for tax. Second, lenders receive only fixed income on provided funds and the shareholder does not have to share profit with them, right? So borrowed funds, they have disadvantages too. First, the higher is the indebtedness ratio, the riskier is the company and the cost of funding and equity rises. Second, if the company faces harsh times and its operating profit is not sufficient to cover interest expenses, shareholders will have to finance this deficit from their own wealth. And if they can't, the company will be declared bankrupt. So companies that have unstable income and operating cash flows should limit borrowed capital. On the other side, those companies that have more stable cash flows have more freedom in attracting borrowed funds. But there's still a question if borrowed funds are better than equity. If yes, should the company be fully funded by equity? And what's the optimal ratio of borrowed funds and equity? The value of any firm is the net present value of its future free cash flows discounted by the weighted average cost of capital, WACC. So change in capital structure will influence the risk and cost of each capital structure component as well as on capital cost as a whole. So change in capital structure can also affect free cash flow, therefore influencing the capital expenditure decisions, otherwise referred to as CAPEX decisions. So capital structure decisions. So capital structure, so in summary, what we are saying is capital structure is a blend of companies' sources of finance and consists of several types of funding. It is a ratio of short-term, long-term liabilities and equity. So we have the factors affecting capital structure. So these are the factors affecting capital structure decisions. So the first one is the cost of equity capital. So what this one means is that there is common erroneous conclusion that equity is free from any cost. That's not true, because where do you get equity? Equity you get from shareholders. The moment you you issue shares, those who purchase those shares are referred to as shareholders, and by the end of the day, they expect dividend, right? So that's a cost to the company, and while in the process of issuing the share, they also incur the flotation cost of issue, their cost of equity capital. So that is a factor that will affect the capital structure decision. So if you want to get to source for more funds, maybe by issue of shares, have that one in mind, the cost of equity. Yeah, it does not come in for free. The other one, the second one, is change in control. Issuing new shares to the open market introduce new shareholders who can have significantly different understanding on how companies should be run. Yeah. the moment you introduce more shareholders, they may have a different understanding on how the company should be run. So it keeps on diluting the control of that particular firm. Then 3, regulatory framework. Yeah, that is the third one, regulatory framework. So this prescribe what proportion of equity a company should have in its capital structure. So those are regulations and policies that are formed, that firms come up with, and they prescribe what proportion of equity and company of equity a firm should have in its capital structure. The fourth one is the debt covenants. So raising debt also usually imposes various debt covenants that restrict a proportion of debt a company is allowed to have. Yeah, so also that one really determines, it's a factor to consider while trying to maybe make a capital structure decision. The other one are other factors, and these one include the cost of debt. Yeah, you don't want to incur debt that is too expensive. The tax rate, these are yeah, the tax rate is also a factor. We have the interest coverage ratio, the cash flow, the net operating income, the capital structure of other companies. Yeah, those are also factors that you really need to look into while making the capital structure decisions. So many companies, they pay dividends which decrease retained earnings and increase the amount of funding. Yeah, so those ones are the factors, and I really hope you've understood something from our today's lesson. Kindly watch out for our next video. Don't forget to subscribe because it will really help this channel, and also hit on the notification bell. Yeah, so until next time, bye.